Global financial markets are witnessing a wave of volatility today as gold prices surge to a record high of $5,417 per ounce, driven by escalating military conflict involving Iran and heightened geopolitical risk in the Middle East. This unprecedented rise in gold reflects mounting investor anxiety and a widespread flight to safety across financial markets. What's happening in the Middle East? The backdrop to this dramatic surge in gold prices is the intensification of hostilities in the Middle East, where a series of military operations and retaliatory strikes have significantly escalated tensions. In recent days, coordinated military actions by the United States and Israel have targeted key military and strategic locations within Iran. These operations, described by officials as necessary to counter imminent threats, have triggered strong responses from Iranian forces, leading to ongoing aerial and missile exchanges across the region. This escalation has raised the prospect of a broader, more prolonged conflict. Market analysts point to the heightened risk of instability in the region, especially with significant energy routes like the Strait of Hormuz, through which a large share of the world's oil flows, now under threat of disruptions. Even brief interruptions to trade through this vital corridor can cause global oil prices to spike, adding inflationary pressure on economies worldwide. Why gold is soaring? Gold is historically known as a safe haven asset, something investors turn to when global uncertainty increases. In times of war, political instability, or economic stress, gold often outperforms other asset classes because it is seen as a store of value that retains purchasing power even amidst turmoil. The recent surge to $5,417 per ounce marks gold's highest level ever recorded. This level reflects not just temporary nervousness, but deep concern among traders and investors about where the conflict might head next. As equities and riskier assets faltered, traders poured capital into precious metals, driving prices sharply upward. Gold's rally is also influenced by a broader pattern of geopolitical instability, including shifts in global reserve dynamics, central bank purchases, and monetary policy uncertainty, factors that have already supported higher gold prices throughout the year. Market reactions beyond gold. The impact of the conflict has not been limited to gold prices alone. Oil markets have also experienced significant stress, with crude prices rising sharply as traders weigh the possibility of supply constraints due to regional disruptions. Major oil benchmarks saw notable gains, reflecting both real and perceived risks to energy output and transport. Meanwhile, global stock markets have reacted negatively to the worsening geopolitical outlook. Investors have reduced exposure to equities, especially in sectors most vulnerable to geopolitical shocks. Emerging markets and highly cyclical equities have seen particularly sharp declines as safe haven flows intensify. In addition, the fixed income market has experienced increased volatility. Traditionally, safe government bonds were expected to attract demand, but rising inflation expectations, fueled by higher energy prices and supply chain concerns, have kept yields elevated and tempered some of the bonds' typical safe haven effect. Broader economic concerns. Economists warn that prolonged conflict in the Middle East could significantly disrupt global economic stability. Supply disruptions in oil and energy commodities could push inflation higher in many countries, complicating policy decisions for central banks that are already balancing growth concerns with inflation risks. There is also concern about global trade routes. The Middle East sits astride some of the world's most important shipping lanes, meaning that any extended disruption could ripple across supply chains, affecting everything from energy to manufacturing and food prices. In financial markets, investment funds and institutional investors are reevaluating portfolio allocations, with many moving toward defensive asset classes like gold, cash, and certain high-quality bonds. Analysts suggest that this repositioning could continue if the geopolitical landscape remains uncertain or deteriorates further. Expert perspectives. According to market strategists and analysts, the gold market is reacting not just to current events, but to the risk premium now priced into the global economy. This premium represents the market's collective assessment of how much uncertainty exists in the near future. One analyst noted that gold's role as a hedge against geopolitical risk has never been more pronounced, with investors willing to accept higher volatility in other assets in exchange for the perceived safety gold provides. Analysts also believe that if tensions continue or escalate, gold could test even higher levels in the coming weeks. However, some caution that extreme market movements can also reverse quickly if diplomatic efforts or de-escalation measures begin to take hold. A short-lived crisis might ease the pressure on risk assets and reduce the intensity of gold's rally. Conclusion. In summary, global gold prices reached a record high of $5,417 per ounce, propelled by safe haven demand following accelerating military conflict and uncertainty in the Middle East. The escalation in hostilities, particularly involving Iran and responses from the United States and Israel, has sparked widespread market reactions, from oil price spikes to equity volatility, and reshaped investor strategies toward assets like gold. As the geopolitical situation remains fluid, markets are likely to stay volatile, with precious metals continuing to play a central role in how investors hedge against risk in uncertain times. That's the latest on the gold market and global economic reactions to geopolitical developments. Stay tuned for more updates as the situation continues to evolve.